Good morning, everybody. This is Patrick MontesDeOca with Live Trading Talk for June 8th, 2022. One of the headlines that grabbed my attention and is grabbing the attention of Main Street media recently is the looming global food crisis related to Ukraine war, which is now dividing the Biden administration. At issue is a plan calling for Belarus to help move grain to the market, with a 6-month waiver of sanctions on its potash fertilizer industry offered as an incentive. Part of the problem, even though there are positive developments here with regards to the movement of grain from the region, according to the Ukraine officials, it will take about 6 months logistically to prepare for transportation of grain. As a consequence of all of the mines that essentially they have to clean up in the area before they begin basically the transportation of grain. So it's going to take at least 6 months. And certainly this is going to put pressure in the production of grains to meet the demand basically for this next season. On top of this delay, and it's pretty unpredictable what could happen in between, it's going to take a long time basically to alleviate some of the tremendous supply shortage that we have. And also we have to take into consideration the new planting season that begins basically in September of this year. It is basically when the harvest in the US is completed. So we have a long way to go in terms of the new planting season. There's a lot of risk here in the United States regarding weather. There seems to be a drought building up. So, the grain markets are affected tremendously by weather and supply and demand. And we've had some issues here in the United States. Brazil, Argentina have experienced also issues, problems, not only in terms of the pressure of meeting the world demand right now in grain, but we have seen a tremendous devaluation on the currency. A stronger dollar, which we've seen here in the last certainly a couple of months since Russia invaded Ukraine, it is not good for exports, for U.S. exports. And so a weaker dollar is more attractive to increase export demand. So I'm paying very close attention to this situation that is building and developing here, that I believe is going to have major impact as we come into the summertime. And particularly in the US here, as we begin to build, or we start basically the next season as we speak, and we already have factored in the old inventories, and now we're looking at the potential risk that the planting season is going to have, and that's going to be basically very unpredictable because of the weather. Continues to show heat and drought, particularly over the next couple of weeks. So these are some of the things that I'm taking into consideration, and we're going to take a look at some of the instruments that I am using to capitalize, to monetize on the situation that I'm sharing with my subscribers here in my private trading room. The other issue that we're dealing with right now is basically interest rates. Well, what is the Fed going to do with regards to inflation? You know, one of the areas that that we talk about and that we look at, which affects the inflation rate and certainly is a big component of the CPI, the Consumer Price Index, is food and energy. And if you really think about the region, the crisis that we're in, Russia, the Ukraine, the whole region is responsible for producing the free world, Europe, a substantial amount of grain. They produce roughly around 30%. But it's not only grain, it's crude oil, it's natural gas. And so this conflict is not just affecting the Ukraine physically, but it is, and it has basically broken the back of the Western economies in terms of their currency. It is pushing towards a weaker foreign currency as Russia continues to build its ruble and continues to work out payments for their commodities in exchange with China, separate from the SWIFT system or the US dollar as the world's reserve currency. Interest rates going up, it doesn't just affect Main Street. It affects the government tremendously, the budget, the trade deficit. We're running over $1 trillion in debt. And we already have seen interest rates rise over 1,000% since 2020, when you really do the math. We had the low on the 10-year note back in 2020 at 0.33%. We're trading at 3.02% right now. The peak of this was about 3.13 here. Just about a month ago. And we've traded down below 290, 275, which is really bullish for the stock market. And this is really what is pricing the levels of stocks, that anything above 3%, anything above 3.25% is bearish for stocks. Anything below 275 makes the stock market undervalued. So the 10-year note is a key indicator in terms of following the money. Where is it going? And so it also affects the general picture in terms of the amount of pressure that this conflict in Ukraine is causing the United States and basically the world on a global basis. I personally am preparing for a major spike into the summertime, and I want to first of all just share with you that interest rates here are in a trading range on the 10-year note, and if it breaks above 3.25, we're going to see probably a massive correction in the stock market. If we revert down below 275, we're going to see a massive rally in the stock market. And we're in a trading range that's defining basically where the stock market is going to go, based on interest rates, based on the cost of money, based on the cost of financing, which has basically thrown the debt market upside down. The bond market is at heavy losses, and anybody that basically borrow or leveraged in the last a couple of years is going to come to terms with what happened here to interest rates. Now, one of the key points that I want to make here is the fact that we're talking about the market making a move, not the Feds. And we have to distinguish the fact that the market is what's dictating where the mean basically is, the price discovery. And we have seen and we saw the market in bonds, in the last couple of years say that, listen, we can't be down here. We got to revert back up. The problem that we're having is the velocity of change that's taken place, and that is disrupting the whole system. It's just turning the whole system upside down. And it's really important to understand how much damage the velocity of interest rates going up this fast, or putting pressure on the Feds to raise interest rates faster, higher, what it could do to the economy. So the market is leading the way, and the markets always lead the way. No matter how big of a government you are, or an individual institutional trader or whatever, you could never beat the market. The market will always dictate where it wants to go. Follow the money. And so when you take a look at this current situation, we have a lot of black swans potentially developing here, as we now have this potential looming crisis developing here, food crisis that could exacerbate this whole economic picture and put more pressure basically on the Feds to what? To print more money, and that's not too good for the US dollar, obviously. So these are the fundamentals that we're dealing with right now, and they just continue to deteriorate more and more, so we're going to keep an eye on that. Now let's basically take a look at the robo-advisor here and see what the monthly standard deviation levels are, and how we basically are monetizing in gold, silver, and Bitcoin. So let's take a look at the monthly gold robo-advisor report.
Hello everyone, this is Equity Management Academy with the Gold Monthly Standard Deviation Report for June 2022. Summary. The monthly trend momentum of 1842 is bullish. The VCPMI of 1849 is bullish price momentum. A close below 1849 stop negates this bullishness neutral. If short, take profits 1782 to 1724. If long, take profits 1908 to 1975. Next cycle due date is July 1, 2022. Trading instructions. Monthly trend momentum, 1842, bullish. The gold futures contract closed at 1843. The market closing above the 9 SMA of 1842 is confirmation that the trend momentum is bullish. A close below the 9 SMA would negate the bullish monthly trend to neutral. Cycle. The next cycle due date July 1, 2022. Strategy. The trend is bullish unless a close below 1842. Monthly price momentum, 1849, bearish. With the market closing below the VC monthly price momentum indicator of 1849, it confirms that the price momentum is bearish. A close above the VC monthly would negate the bearish signal to neutral. Cycle. The next cycle due date July 1, 2022. Strategy. The price momentum is bearish unless a close above 1849. Monthly price indicator. Exit, longs, sell 1, 1908. Sell 2, 1975. Exit, shorts, buy 1, 1782. Buy 2, 1724. Look to take profits if short on corrections at the 1782 to 1724 levels and go long on a weekly reversal stop. If long, use the 1724 level as a monthly stop close only in good till cancelled order. Look to take profits on longs as we reach the 1908 to 1975 levels during the month. Cycle. The next cycle due date July 1, 2022. Strategy. Take profits on short 1782 to 1724. Take profits on longs 1908 to 1975. The price momentum is bearish. A close above the VC monthly would negate the bearish signal to neutral. Cycle. The next cycle due date July
what we're looking at is the average price weekly of 1264. And we're looking at the daily average price of 12,611. We're looking at the NASDAQ, and it is in a bullish, neutral to bullish pattern with a target of 12,810. What I want to do is show you basically how I trade those fundamentals that we looked at, and particularly in the NASDAQ, the gold and silver market, and Bitcoin. The weekly mean for the gold market is 1854, and we were looking at the monthly mean of 1849. And what you see here is that the market is trading above the monthly, above the weekly, above the daily average price. This is the monthly standard deviation targets that by trading above 1849, it's given us 1908 as the sell one target, which is what the robo-advisor is identifying. So the pattern is bullish. It's a bullish price momentum with a target of 1908. It closed below 1849 would negate this pattern, this bullish pattern, and another close would activate the levels below of 1782 to 1724, which are the levels that the robo-advisor was anticipating. Now, when I'm looking at this, in what I'm basically recommending in teaching my traders in my live trading room here in Discord, is that you want to listen to the fundamentals, but you want to trade. You want to trade the standard deviation levels. The math of the market, because by the time the price reaches these levels here, it's already been factored in. The fundamentals have already been factored in. And you want to be systematic about entering the market and exiting the market if you are a short-term trader. If you define your trading for day trading, you use the day trading numbers, or make sure that your objective is to make a day trade as quickly as possible. And pretty much that's what we have done here in our trading room. And this is pretty much what we do here. We are completely transparent about the trades, and we document the trades. And for self-directed individuals, you can use this intelligence according to your profile. We're showing a tremendous results in applying the VCPMI to my own trading live in here. And I think we're up over 100% since February that we started applying this. So we use this basically to execute the trades. And here you can see today we already made about $900 on a day trade that we took in the silver market earlier. So the room is pretty much open literally around the clock, and when there's a trade produced, we share that with our private subscribers. And if you would like to join us, in the live Discord, let us know. We'll be more than glad to send you a trial. Taking a look at the silver trade here, the silver market was the one that had the best setup here today to execute a trade, basically. And what you see here is the market traded into this buy one level daily that we came in today of 21.96. It also has a weekly average of 21.96. Now, when this happens, this is the highest, most optimal relationship of the algorithm between the daily and the weekly. And this is where you prepare and let the market tell us. But we teach the methodology basically in our trading room. And basically the philosophy of price to standard deviation. And in this case, it was telling us that the standard deviation was at the extreme below the weekly mean and into an area of accumulation daily. When the price is in blue, it automatically prepares you for the possibility that when it comes down, it could revert and see new buying come into the market. And this will determine basically the amount of supply or the strength of any seller coming into this area. And we teach and recommend do not sell in here, even though you may get this kind of a move up, testing this level of support. This is where you want to buy. And that's exactly what happened. We got a trigger point right here, and when the trigger point was activated, the target was activated automatically and completed now. And this is the trade for the day that we did, basically. So what you're looking at here is the standard deviation activating the mean reversion, which the algorithm has embedded in that identifies these pivot points with the highest mathematical probability of a reversion to unfold. This is a very specific structure. Now, if we get a close about 22.13 here using the 15-minute bar, we are activating the upper levels of resistance, which is the 20.42 to 22.50. I hope you had a deep insight into how I'm trading these markets and monetizing from these markets to accomplish the returns that we're accomplishing here. Feel free to like and subscribe. In the meantime, my friends, we'll talk to you soon. Have a great trading day. Have a great trading week.